Hello and welcome everyone to the second phase of, I should say the second part of Module 2 on deforestation risks for banks. Last week we talked about the various approaches for the risk assessment or risk identification process, and pardon me, this module will cover identifying where the different deforestation related risk assessment tools fall within the risk management stage and how to use them. So we're going to be delving a bit more into the three lenses that we talked about last week. We're going to commence with the reputational risk lens, followed by the legal lens, and then finally the financial risk lens. And I'm going to hand it over to Rodrigo, who's going to kick us off with the reputational risk lens. And I think this is it, Rodrigo. Is this, are you okay to go?
Yes, that's fine. So here are the speakers. As always, Module 2, as Lara just mentioned, will be covering the three lenses that we presented in the last week. So reputational lens, legal lens, and financial lens. Next slide, please. I will be starting talking about reputational lens. So examining risks related to negative publicity, reputational damage associated with financing forest risk companies or companies that are operating forest risk jurisdiction. Lara will be presenting the legal lens, so examining risks linked to current and future regulation that are likely to be more stringent in relation to forest-related activities. And Jonathan will end the training today by talking about the financial lens, so examining what's probably the less explored element of risk in the context of deforestation, which is the risk ultimately affecting portfolio of companies from a revenue and profitability perspective. Next, please. So starting with the reputational lens, and next slide, please. So starting with three key questions when thinking about reputational risks in general. And as I go through them, I would like to ask you to reflect on how those relate to your portfolio when it comes to deforestation risks from our reputational lens. So when examining reputational risks, you could ask, which are the threats in your risk register currently that could be amplified to additional reputational damage? Or in what ways the bank could be caught up in fallout from incidents at competitor suppliers or mainly clients? And how might reputational risks of crystallize, develop, and ultimately affect the bank financial performance? When looking into reputational risks, what we would do is to try to identify the stakeholders and data sources to analyze stakeholder information. So considering internal and external stakeholders, including regulators, shareholders, employees, and especially clients. Tap into a variety data sources for a more complete perspective. And we will be introducing a number of tools here today that could be useful data sources in this context. And what to analyze? The idea then of this analysis would be to identify factors that indicate changes in stakeholders' expectation and leading to potential reputational risk. Next, please. There are different drivers of reputational risk. And here we have a list of those drivers that can be associated with deforestation in particular. Those are examples taken out of a pilot questionnaire that CDP asked financial institutions to respond last year, focusing both on climate and forest-related risks. So those, I will again run through the slides asking you please to reflect on which of those drivers outlined or eventually others would you consider more damaging in the context of your organization when taking a deforestation focus. So it could be shifts in consumer preferences. We saw lately movement towards more plant-based diets, moving out of what's considered more environmentally damaging protein-producing activities, or stigmatization of whole sectors in which your clients operate. We hear a lot on palm oil and the palm oil sector in general being affected by this perceived bad reputation. Negative media coverage related to financing activities that damage forests. Increased stakeholder concern and stakeholder feedback linked to deforestation aspects. Lending that could then be perceived as creating a systemic risk to the economy. And here's one aspect that links directly with the climate agenda as well. So deforestation perceived as a major activity that emits a lot of CO2 as well, or more on the ground kind of driver would be local community opposition to companies you lend to, for instance. So there are several potential drivers of reputational risk, and that's the key message of this slide. Next, please. When it comes to analyze potential reputational risks associated with the bank's lending to companies that are in some way associated with forest risk commodities, we would again suggest adopting a sector and geography concentration perspective, which is something we covered in the previous session of this training. So it's important to go back to this thinking about geographies and sectors that are more associated with deforestation risks and look at these through a reputational lens. Deforestation risks to banks will more likely be associated both with sectors and they finance and geographies where clients produce or source forest risk commodities from. So reputational risk to some extent, when we talk about deforestation, it's grounded on the sourcing or producing region and the different sectors where your clients operate. The examples we will see next, they illustrate the importance of grounding reputational risk to a geographic or sectoral perspective. We will also be presenting suggestions of useful tools to be used in this context. Next, please. So in some cases, all the information you might have about your client's link with forest risk commodities will be the country in which it operates or where it is sourcing its commodities from. This first high-level information already can provide some insights into reputational risks by looking to the perceptions and the known issues that particular commodity faces in that particular country. In the example here, we have an example from soy production in Brazil using GMAP, which is one tool that's from IFC, which is freely available. So the global map of environmental and social risks in agro commodity production. That's one tool that you can use if all the information you have available is the country where the company operates or where it is sourcing from. This will provide, tools like GMAP will provide a high level understanding of what are the issues that soy production in Brazil faced. And that's then for the bank to analyze how those issues might eventually reflect into reputational issues for the bank. You can use different data sources, but GMAP is one interesting source that's freely available for this purpose. But this is still high-level information, so it's a country-level perspective, and for countries of this dimension, it might not provide you the full picture. Next slide, please. In other cases, you might have more granular understanding of the source of forest risk commodities associated with your client, be it from a production or from a sourcing perspective. So if the information you have available goes down to the subnational level, for instance, you can be using other tools to further investigate potential reputational issues linked to the production of the commodity in that area. And this can lead to a better understanding of potential reputational risks. More granularity at subnational levels provide a better picture of the actual risks in countries like Brazil. We saw the example of soy in Brazil in the previous slide. If you look at Brazil, not all soy producing regions are in the deforestation frontier or in areas associated with deforestation. So although the high level picture of the issues linked to soy production in Brazil are relevant, this might not provide a full picture. But if you knew the state or the municipality that's where the commodity is being sourced from, this allows further investigation on what are the actual risks and potential reputational consequences linked to sourcing and producing commodity in that particular place. One tool that can be used for this more in-depth analysis would be the Global Forest Watch. We will see a video on Global Forest Watch later during the presentation, but it will provide a kind of historic land cover, forest change, and forest fire information that if you want to zoom into one particular jurisdiction where you know that clients are sourcing from or producing, this can provide relevant information from a jurisdictional perspective. Or a reputation perspective, sorry. Next, please. You could also start, apart from looking at jurisdictions, you could start looking at how your own clients are perceived by the public or by the media. So another way to get into reputational risks in the context of deforestation would be by looking into low performance company clients in your portfolio. The bank can use different approaches, but there are several organizations and initiatives out there dedicated exclusively to assess companies' performance in the context of deforestation. Just to provide some examples, there will be tools like ZSL Spot, CDP, Forest 500, and all those, they score companies based on information available on how they deal with forest-related issues and deforestation more generally. And data from those can highlight companies that are particularly perceived as particularly risky or that are not perceived as good performing companies in this space. The graphs here, they show the use of two of those ratings. One is ZSL Spot, which is providing information on more upstream companies, so more closer to the production of the commodity, seeing how finance is divided by the different bands. So you could start looking at how your clients would be allocated into those different bands of performance using spot scores, rankings. And the other picture here from Climate Advisors has used Forest 500 data and rankings to classify how finance is allocated to well-performing or low-performance companies. Next, please. Next slide. You could also focus on specific issues. So if some issues are perceived by the bank as more relevant from a reputational perspective, for instance, do my clients have a deforestation-related commitment in place or not, you could then deep dive into specific data points. Those initiatives and organizations mentioned before, they provide basis for that analysis, but you can also try to get this data in different ways, could even be based on internal data you gather on your clients. And in this case, the bank can identify an aspect that particularly worries the bank from a reputational perspective and pull out an assessment for that specific aspect. The example shown here is one from BNP Paribas. They've looked into the percentage of their corporate, the lending companies or companies they invest in, covered by CDP, Forest 500, and Spot data, looking particularly into policies and commitments from those companies or traceability. So how companies that are part of the portfolio can trace back the commodity to the production jurisdictions. and basically split those into strong, average, and weak. So if you have a larger proportion of companies in the weak portion of that analysis, this would likely indicate a more greater chance of reputational risks. Next, please. Another approach that could be used to indicate your exposure to reputational risks would be to look at the how your clients deal with certification or sustainability certification schemes for forest risk commodities, assuming here that clients with larger proportion of the sourcing or the production coming from certified areas, they are less exposed to reputational risks than others, because there will be a check by a third party. That's not the bank that's doing this check and certifying. So, and the example here covers different commodities. This is an example from Barclays, looking at certification status on palm, timber, and soy for clients as well. So, and the question here is how much of your clients' land is certified under various sustainability schemes, or how much of your clients' sourcing is certified under different certification schemes. Next, please. This is a table summarizing different tools and initiatives out there that could eventually provide data for this kind of analysis from a reputational lens. Some of which I've mentioned during the presentations. So CDP Forest, Forest 500, ZSL Spots. WWF also produces what they call scorecards on palm oil, soy, and timber. In this case, focusing on companies' downstream supply chain, so on the retailers and manufacturers side of things. There are also commercial solutions. So RepRisk is a well-known commercial provider of data about on risks, and which also covers impacts on landscape, ecosystems, and biodiversity. And supply chain is an initiative that's kind of an aggregator of data on assessments of forest risk commodities in different companies. So they have a larger number of companies assessed because they basically compile information from several other initiatives. So the different tools will cover a different range of companies, and you have to identify which one would be suit best the kind of analysis that you would be doing. One key caveat here is that the information is many times based on publicly disclosed information. So there will be an inherent bias towards data collection based on market cap or companies that are more exposed by media. So not all your clients will be covered by this initiative. So finding innovative and creative ways of getting data would also be relevant. We will next view a short video. Next slide, please, Laura. A short video that kindly prepared by Global Canopy, which is the organization behind the Forest 500 initiative, where they explain how to use this particular tool for deforestation assessment or to check deforestation risks associated with companies. Let's watch the video, please.
I'm Emma Thompson, and I manage the Forest 500 project at Global Canopy. I'm going to walk you through how you can use the Forest 500 data to find out how companies and financial institutions are addressing deforestation risks. Forest 500 is an annual assessment of the 500 companies and financial institutions that have the greatest influence on tropical deforestation based on their exposure to deforestation risk. You can use the Forest 500 data to identify which companies and financial institutions are exposed to deforestation risk, explore what they are doing to minimize that risk, and use it to compare the performance of different companies and financial institutions. In 2020 alone, the tropics lost 12.2 million hectares of tree cover. The 350 companies and 150 financial institutions in the Forest 500 are selected based on their exposure to the 6 highest forest risk commodities: palm oil, soy, beef, leather, timber, and pulp and paper. These commodities are the biggest drivers of tropical deforestation. We identify the 350 companies by using data including volume of commodity handled and share of relevant markets, depending on whether they are producers, processors, traders, manufacturers, or retailers. We then identify the 150 financial institutions who are providing the most finance to those 350 companies through shareholdings, loans and underwritings, and bond holdings. By identifying those with the highest exposure to deforestation risk, Forest 500 data is a useful starting point for high-level assessments of exposure to deforestation risk through clients or holdings. The companies and financial institutions are annually assessed on the strength and implementation of their publicly available deforestation commitments against best practice for the sector. Our methodologies are aligned with the Accountability Framework Common Methodology, the leading standard for assessing performance on deforestation. The assessments only use information that is publicly available from the websites of the companies and financial institutions, working with a team of language consultants for sites that are not in English. So let's start on the Forest 500 homepage. You can click here to explore the rankings. You can also find them in the menu at the top. This is updated with the new assessment data in January each year. Each company and financial institution receives a score out of 100, which can be broken down, allowing you to see how well they score for different commodities, or whether they have policies on labour rights or smallholder inclusion, for example. So now you can see the ranking for the companies. The default view ranks from highest to lowest or best to worst, but you can sort this using the options at the top of the page. You can get a high-level assessment of the action being taken by companies and financial institutions to address their exposure to deforestation risk by looking at the companies and financial institutions with the lowest scores. Or you can select the companies exposed to deforestation risk through specific commodities, for example, palm oil. Or you can search for a particular company or financial institution and explore its score in more detail. You can look at the assessments from each company or financial institution's profile page, with links to their quotes, policies, and relevant information, meaning you can dig deeper into the detail of what your clients or holdings are doing to address their exposure to deforestation risk. The Forest 500 assessments benchmark companies and financial institutions against best practice, with all companies assessed against the same methodology and all financial institutions too. This means all assessments are comparable, so you can compare the strength and implementation of deforestation commitments to others included in the Forest 500, but also to other clients or holdings. If a company or financial institution doesn't score for an indicator in the Forest 500 methodology, this highlights a gap in their approach to addressing deforestation or associated social issues in their supply chains or financial portfolios. All Forest 500 assessment data is publicly accessible and is also available to download for further analysis offline. This means Forest 500 can be a useful tool for engaging with clients or holdings. We know that a number of financial institutions are already using Forest 500 data to better understand their exposure to deforestation risk. So please do explore the data and get in touch if you would like to know more.
Next, please, Laura. Yes. So once you have identified the risks, the suitable data points that you want to use to interrogate your portfolio, you can actually move towards the assessment of severity of risk. And that's what we'll be covering in the next few slides. So the framing of risk severity will depend on your instance as a bank, which measures you will take more seriously. For instance, if you'll be looking into fires or deforestation, the actual loss of forests, and media coverage on the clients or other topics that you identified as the ones more relevant from a reputational perspective for you. So remember that your chosen data points should depend on the bank's priorities for reputational risk. Next, please. As risk assessments at this stage, so trying to actually quantify and measure the severity is a time-consuming exercise. You will need to spend a decent amount of time digging into companies individually. So ideally, this would be focused on a subset of your companies of your portfolio. So for ones that you selected are more critical for and deserving of further assessments. Once you define that subset, and the graph here is just indicating one potential way of doing that. So it's basically companies on the portfolio of Chinese financial institutions based on different criteria, whether there is any indication of deforestation or community rights, social issues. So this is just an example how we could be looking into selecting companies apart from sourcing regions and sectors, as we mentioned before. The selection of companies depends on a number of things: the tenor, the size of loan, longevity of the relationship, exposure to loan products, reputational risk to the bank, for instance, media attention, and so on. So it's just, the message here is just that depending on what you'll be focusing on, select the most critical companies to further the analysis. Next, please. One way to be looking at this would be to look at the actual loss of forests that can be linked to that particular company that you are assessing. So one way of looking at assessing the severity of risk would be to look at the area of forest deforested by the company, if you have location data for that company or in the jurisdictions that they operate. So if you know that that particular company operates in certain jurisdictions, you could be looking at deforestation rates for that particular jurisdiction, what starts to provide a better understanding of the kind of risk that is. It's a good proxy for severity of risk, reputational risks. You could look into different data points depending on your focus. So, but one key point here is that location data is critical for this kind of assessment. So either you know the boundaries of the farms that you're lending for, or know the places where the commodity is being produced or sourced to use proxies for that assessment. But you could be looking into loss of primary forest, trend in annual deforestation rates, observed fire density, and other points. There are tools as well that can be used for this. We will be covering one of those tools in a few slides. Next, please. You could be looking into fires, for instance, if that's an issue of concern. This is an assessment that was prepared back in 2020 when fires in the Amazon were high in media, in terms of attention from the media. So, and the chain reaction research actually looked into different companies and how those companies could be associated with that increased fire in the Amazon in that particular year, based on data from NASA and associating that with different companies over time. Next, please. Yeah, one particularly useful tool in this context is Global Forest Watch. For instance, and we will be seeing a video about it in the next slide. You could be looking into measuring deforestation area linked to a loan to identify potential liabilities. And then with information from the clients, like point locations or polygons, try to identify how that particular client is linked to deforestation over time. It could be past deforestation. It could also relate to a monitoring of the deforestation, ongoing monitoring of deforestation. And just to mention a recent interaction we had with Rabobank in Brazil, for instance, they have a system in place that tracks deforestation changes in ecosystems in the farms they associated with their loans over time. So every 15 days, they get the reports on eventual changes in the forest cover or ecosystem cover in the farms from the clients, but eventually triggering client engagement and to mitigate or to solve that issue. So Global Forest Watch, it's a tool from the World Research Institute that has been providing information globally on forest change or land use cover change for a number of years now. And we will see next a video that explains it to a bit better. Next, please.
There's an old saying, if a tree falls in the forest and nobody hears it, does it make a sound? The truth is, we've all heard shocking statistics about deforestation, like the world's forests are being destroyed at a rate of 50 soccer fields every minute. But there's still a lot we don't know, and a lot we don't hear, like when and where forests are cleared, why it happens and who is responsible. And most of the time when deforestation is eventually identified, it's already too late. This is why the World Resources Institute and partners have developed a groundbreaking initiative to monitor the world's forests in near real time. This is Global Forest Watch. Cutting-edge algorithms harness the power of satellite technology and cloud computing to identify where trees are growing and disappearing. Data that would have taken years to process can now be viewed and analysed in a matter of seconds. With Global Forest Watch, a government official can now see where forest clearing is happening in near real time or sign up for automatic alerts. And law enforcement can stop the illegal logging before more forest is lost. A business manager buying commodities such as palm oil, soy, beef or wood pulp can now use Global Forest Watch to see if suppliers are clearing forests they committed to protect. A local farmer can raise the alarm when their community's forests are threatened by uploading a call to action from a mobile phone. And everyone can participate in building Global Forest Watch by helping review the satellite data, sharing stories from the ground or using the information to campaign for change. What does this all mean? This ambitious partnership helps overcome the Forest Information Challenge and gives users the power to stop harmful forest loss. And it is free and simple enough for anyone to use, so governments can respond quickly to illegal logging. Businesses have more control over their supply chains, and academics, NGOs, the media and the public gain a wealth of information. So now if a tree falls in the forest, everyone hears it. Take action today by visiting globalforestwatch.org and find out how you can help protect forests everywhere.
And just to say that the links to all those tools that we are mentioning will be shared later as part of the additional complementary materials as well. We have shared a folder with all the materials with you. You should have received the links so far. So if you haven't, please reach out to us. We can point you to the right place to get those materials. So following this video is a good moment right now to make a point on the use of geospatial data for your risk assessment. So geospatial data can be very useful when it comes to deforestation risk analysis. Banks can use geospatial data to see whether forest it's being lost anywhere in the world or where fires are taking place on a farm or forest or concession, and so on. This data can help inform the assessment of the risk associated with financing forest risk commodity in certain places, and also connecting with the assets you have in your portfolio with observational data on the ground. Costs, of course, need to be weighted against your objectives and scope. Geospatial data is an example of qualitative risk assessments, but it can also be financially costly, because of the need to use external providers, or because you have to build your own capacity to be dealing with this kind of data. There are a number of service providers out there, and also freely available tools. It's a matter of balancing whether you have in-house capacity to deal with geospatial data, whether data from your clients can reflect into location data that can be used in this sense. But the summary is that it is really useful for risk assessment in the context of deforestation, because deforestation is a localized problem. So it is a location question. It depends on what's happening on the ground in certain places of the world. Next, please. Just to summarize some key messages from this approaching your risk assessment from a reputational lens. As we mentioned, the sector and geography analysis will be helpful to start shaping the understanding of reputational risks associated with a particular forest risk commodity in a particular region. You should consider risk at client level, so using data available from performance ratings or data that you have internally to look at the proportion of your clients that are low performing clients or high performing clients, or even tap into specific issues like certification and look into how your clients are doing on that particular topic, if that's the topic that you selected as of greatest interest to the bank from a reputational perspective. So depending on your priority, your analysis will be based on different data points. As we presented, it could be looking at policies, traceability, certification, fires. It will depend on how you shape the lengths and the discussion on the breadth and depth that we presented in the previous session as well. Now Lara will be covering the next part of this session on, next slide please, on legal lens.
Thanks, Rodrigo. Yes, so next slide, please. So yes, as Rodrigo mentioned, I'm presenting the legal lens. The legal lens encapsulates an assessment of applicable law and emerging legal risk associated with the company, the region, and or the client. It can look at either present legal risk or going beyond what the law currently requires. So as we've heard from the previous section, often reputational risk can also confer potentially legal risk to the clients and subsequently the bank. We've also heard that certification schemes also provide a kind of window into the reputational risk for a client and a bank. However, in this case, certification schemes can be useful proxy indicators for legal compliance as well, since many certification schemes require compliance with law in addition to requiring companies to adopt best practices. So some examples of certification schemes are given on the right of the table on your slide for various commodities such as palm, timber, soy. And of course, there are instances where there are competing or similar national certification schemes that have been introduced. And then, of course, your clients are bound to follow that scheme, but you can also ask them to adopt international best practice. So an example of this is in Indonesia, where the government introduced the ISPO, the Indonesian Sustainable Palm Oil Standard. So in that instance, clients are asked to follow ISPO as the base requirement, and then oftentimes go beyond that by either adopting the RSPO or going beyond that. Next slide, please. In using the legal lens to identify and assess risk, as I've mentioned, this is not only an assessment of current applicable law, but also a potential emerging legal risk as well. So the column on the left provides some examples of current and emerging regulatory risks related to land use and deforestation specifically. So things like mandates or the lack of mature certification. One interesting example, no, can you please back up, please? Yes. One interesting example is the moratorium or various moratoriums that have been introduced, because they can be interpreted as both carrying reputational risk, as Rodrigo mentioned, and legal risk once violated. So an example of this is the Amazon soy moratorium, which was an agreement signed in 2006 to ensure that soy production in the Amazon region only occurs on existing converted agricultural land and not through deforestation on native or primary vegetation. So since that time, hundreds of investors and companies have signed on to an initiative to support the continuation of that moratorium. And the legal consequences of these laws and regulations, is for the bank and their clients, you can have exposure to litigation and or sanctions, uncertainty around forest risk commodities produced and consumed by clients. You can have the regulation and supervision of forest-related risk in the financial sector. So this is definitely an increasing trend in many countries. Lending could contribute to systemic risk for the economy as a whole. Next slide, please. So as we've discussed in Module 1, regulation is becoming an increasing reality in in many jurisdictions. In Paraguay, for example, a country facing one of the highest rates of deforestation globally, the Central Bank of Paraguay adopted Resolution 8 in 2020, which makes ESG integration compulsory for banks they supervise. This table shows how various jurisdictions such as Brazil, Colombia, Peru, Indonesia, and Malaysia integrate these considerations in these deforestation risk considerations and ESG considerations in their national laws. The challenge, of course, for any jurisdiction is the implementation of these regulations. And I think for many banks, needing to comply and implement these new laws in their lending, we can sort of enable the implementation through a common understanding of definitions such as legal deforestation, what constitutes land tenure in that country, the data availability, integrity, and accessibility. And then, of course, transparency. Next slide, please. Thank you. So here is an example of how an internal bank screening could look like for forest risk products. This example was taken from the Sustainable Forest Finance Toolkit from PricewaterhouseCoopers. And it shows how different types of risks can ultimately boil down to legal issues such as avoiding high-risk locations, such as unsecure land tenure or overlap with primary forest areas. So in this particular instance, we commenced with the screening or assessment through basic screening of knowing the sourcing region. As Rodrigo mentioned, deforestation risk is a local risk. So place, geography, region, and then sector are of primary importance when undertaking a screening through different lenses. This was step one, and then that was followed by several assessment questions and qualifiers aimed at the site level, and then the operational or management risk, and then the reputational risk, which in this instance was called track record. So again, this example shows how a variety of risks really come down to avoiding high risk regions or jurisdictions. Next slide, please. We've seen the slide before in module 1 and again in the reputational risk lens. And, it really is, it indicates that subsequent to assessing your portfolio concentration and risk exposure, really understanding your geographic location of your clients and where they're sourcing from are important qualifiers to include in the legal lens risk. In the next few slides, we'll look at how the results you pulled together in the scoping stage of your risk can be spread through the sector and geography. And it will be quite useful in assessing risk through the legal lens. Next slide, please. So we're first going to start looking at the portfolio level assessment as we've done with reputational risk. Thank you. The first step in the identification of legal risk is the analysis, as mentioned, by geography and sector. And again, the legal risk conferred for particular commodities will vary by country, by region, and subnational jurisdiction. So really understanding, sourcing, where your clients are based, where they're doing their business is of paramount importance. And the key message here is that you shouldn't treat country risk and commodity risk separately, given the interplay between these two factors. Next slide. We've seen this slide before from Rodrigo's overview of reputational risk. This is a GMAP tool again. And similar to reputational risk, it can also help you identify legal risk in a geographic and sectoral context. And I think here, the selection of this tool will depend on your existing capacity, your strategy, your available data, and your initial assessment of loan books. In this example, GMAP can help provide accessible information on national laws relevant to different aspects of the IFC performance standards. I know many of you are using the IFC performance standards as sort of a base for your lending, beyond project finance as well. So this high-level assessment can help banks assess how risky country-level laws are, and if the client is in compliance with them or not. Next slide, please. And I see a few questions come up, and I think maybe we can take those at the end, if possible, unless the other presenters, Rodrigo and Jonathan, would like to take them as I continue to present in the interest of efficiency. So we've seen fire as well as another type of risk, also in the reputational risk section. A tool that can be used for identifying legal risk at a country and commodity level is Global Forest Watch fires. So fire hotspots are a potential risk from a legal perspective, as in many countries, a lot of those fires are known to be illegally started. So Global Forest Watch fires tool can help you monitor historical data at a subnational and national level. Next slide, please. So another type of risk to be aware of at a portfolio level is tenure risk, because unclear tenure on land or competing land claims for the same land could leave clients open to legal disputes, as their claim on the lands can be quite risky for bank lending to them. So another aspect is also understanding if there's free, prior, and informed consent before clients start production, especially at the concession level. The tool highlighted here, which can provide that overview of tenure risk, is called Landscope. So it gives a high-level assessment of tenure risk. And, but at the end of the day, to get a true understanding, on the ground assessments are usually needed, especially if you're lending to a client that is producing on at a concessional level. So we're going to talk about tenure risk probably in the next in the next section for the financial lens. So I'm not going to go through that slide too much. It's just to sort of highlight that tenure risk is one of a multitude of risks that you should consider when trying to kind of understand the legal risk exposure of your clients. Next slide. Yes. So now that you've done your portfolio level analysis, to achieve another set of granularity, you will want to look at the client level exposure to legal risk. Next slide, please. You would do that through your own internal analysis. This can sort of take many forms, such as client onboarding questionnaires, the Know Your Client process, your annual reviews. You could do that through basic desktop reviews or searches. And we've gone through a number of tools previously that can give insights into client ESG performance as it relates to deforestation risk. One of the important aspects is looking at deforestation policy, deforestation-free targets and traceability ambitions, and enforcement of those policies through contracts, codes of conduct, and audit and verification schemes. Yes, next slide, please. We're going to have a short video by Trace Finance. And Trace Finance will sort of go through a tool that can help banks identify the companies in your portfolio if they're currently under embargo or if they've committed legal violation. So again, there are a multitude of ways in which you can sort of identify individual client exposure when it comes to legal risk. Can you please play the video?
This is Trace Finance, a tool that connects investors and lenders to deforestation via their financing of companies trading soft commodities. It enables financial institutions to identify and assess deforestation risks in their portfolios, undertake client due diligence on deforestation, and develop metrics for deforestation-free products. It also provides transparency for governments and civil society by revealing private and public companies' financing flows, allowing greater accountability. The platform currently covers international trade of Brazilian soy, Brazilian beef, and Indonesian palm oil, commodities associated with the majority of deforestation globally. You are able to search for individual companies or financiers. For example, we can search for Bunge, which has more than 300 subsidiaries, and then filter to find the ultimate parent company. Company profiles contain key information such as company identifiers, trading volumes, as well as risk flags on deforestation exposure, company deforestation policies, and violations. The Deforestation Risk tab uses data from trace supply chains to show the deforestation risk exposure of a company benchmarked against its peers. You can also look at a company's financing under the Financing and Ownership tab. This includes information on equity, bonds and loans, and their respective holders and lenders where this is known. You can also view the company's legal hierarchy to identify the ultimate beneficial owner and identify high-risk subsidiaries. Watch our tutorial video to learn more about company profiles on Trace Finance. Trace Finance also allows you to search for financial institutions such as BNP Paribas. This will show their subsidiaries and funds, and you can also filter to find the ultimate parent. In the financier profile, you can see which commodities a financier is exposed to through its financing and explore detailed breakdowns of this exposure for its shareholdings and its associated deforestation risk, as well as its bond holdings and loans. You can explore a financier's indirect exposure to deforestation risk through the Corporate Network tab. For example, BNP Paribas has indirect exposure via its holdings in Citigroup that has loans with a number of palm oil trading companies. Watch our tutorial video to learn more about financier profiles on Trace Finance. Another feature of the platform is the ability to view and create watch lists. Public watch lists include those showing the top 10 equity and debt holders in terms of exposure to deforestation risk in each of the 3 commodities. Log in to Trace Finance to create your own private watch lists, which you can edit, save, and come back to. For example, here is a watch list highlighting Norway's government pension fund's high-risk holdings. If you have questions about Trace Finance, you can go to the methodology and FAQ sections on the platform. We hope you enjoy exploring Trace Finance. Watch our tutorials for more detail on how to use the platform to understand and manage the risks of financing commodity-driven deforestation.
Great, thanks. So as I previously mentioned, voluntary certification schemes are a good proxy for compliance with national law. There are a number of other data points and approaches that you can utilize as well, such as national certification checks. I've mentioned ISPO before, the Indonesian Sustainable Palm Oil Standard. You could look at grievance and complaints databases. The OECD guidelines have a grievance process, as well as the certification schemes as well. You could look at embargoes and fines levied against a particular client. And you could also do your own environmental impact assessment check. So, for example, listing of companies within the voluntary certification list is actually a good sign that they're in compliance with national laws as well. However, if they're listed on embargo lists, then it would be a flag to further undertake some due diligence and a likely sign of legal risk. Next slide, please. We've seen these examples before in Rodrigo's section on the various tools that you can employ. These are data points that can be used for assessing not only reputational risk, but legal risk as well. And many of them are publicly available as well. So next slide, please. In addition to the tools previously mentioned at the portfolio and client level, there are many important data sources that are relevant at the national level that are relevant for your clients and consequently for you as a bank. So for example, in Brazil, there are a suite of tools for assessing deforestation risk from a legal perspective. You've got a number of databases, IBAMA, you've got SICAR, and Mapobiomas, the last of which reports and provides a sort of visualization of farm level deforestation and overlaps with protected areas. But you can have a number of other data points as well. Pardon me, I'm just having a bit of technical difficulty here. Okay, next slide, please. Next slide, please. Yes, thank you. As before with the reputational lens, we've already talked through how to identify risks at the portfolio level. Now we want to sort of move on to consider how to assess the severity of risks in a couple of examples. Next slide, please. So to conduct a legal risk assessment, as Rodrigo mentioned, with the reputational lens, geography is everything. First, you need to identify the area you wish to analyze in some substantial detail. So understanding the source of your high risk commodities from your clients. This sort of can be done through a number of indicators or data points, such as the percentage of overlap with the concession to key forest areas, overlap with protected areas. This could be done through the UNEP WCMC monitoring tools and Protected Planet. You could look at the overlap with potential moratoriums on peatlands. So there's sort of a number of ways that you could sort of do a kind of first cut of your risk assessment. Next slide, please. So similar to the exercise in the reputational risk assessment, fires are also a potential legal issue. And here, having an overview of where the fires are taking place and where your clients are sourcing from can be of primary importance to sort of understanding compliance. This is an example from chain reaction research. And given that we've already dealt with this from the reputational risk perspective, I'm going to skim over it and head to the next slide for key messages. Just to sort of recap that banks should be aware of the applicable laws and consequently the legal risk that is conferred and associated with their clients, the regions and commodities in which they operate. Different considerations can provide a good proxy for compliance with national laws, such as alignment with IFC standards or compliance with various certification schemes. And you've got a number of tools available at your disposal that you can use to sort of better identify and assess compliance with laws. And I think we sort of want to end there and have a 10-minute break. So we will come back at, well, within 10 minutes. Let's just put it that way. I know we're all in different time zones.
So welcome back, everybody. We are now moving on to the third lens that is covered during the session, which is the financial lens. So the financial lens, in contrast with the other two lenses that were presented before, looks at deforestation risk from the point of view of its impact on financial metrics, such as the delinquency rate, the cost of capital, or the risk correlation between different risk positions. The financial lens will try to answer questions such as, for instance, if my client continues to deforest heavily and beyond the legal allowance in their concession, what can be the impact on their ability to repay their loan? Or does deforestation put them in a risk bracket that is not comparable with the risk profiles of their peers who do not deforest? Shall I need to increase my interest rate or introduce mitigating mechanisms like insurance to address the excessive risk exposure? So as you can see, it is a vast field of research that has started to receive specific attention only recently and is therefore superficially explored. Very few applications to date have tried to quantify a relationship between deforestation and credit performance using established credit modeling techniques. And that's for several reasons. First of all, relevant data is difficult to get, especially data that provides combined information on the environment, the productive system, and variation in the level of productivity. But secondly, and we'll show it in a minute, risk transmission pathways between the environment, the real economy, and the finance world are extremely difficult to accurately model because they are intrinsically highly dependent on specific context, and also because economic and financial transmission drivers are often influenced by myriad of unique factors, regulatory conditions, mitigating strategies that make generalization very difficult. It requires that the bank's risk team has sufficient knowledge of risk aspects that are often outside of their normal remit and by nature interdisciplinary, like climate, ecological, agronomic, or extreme event risk analysis. And so for all these reasons, this section only aims to provide a general idea of what's possible through a few examples and by highlighting key considerations. Anyone interested in a more thorough deep dive would be encouraged to dedicate resources to a proper review of the literature, obviously. Next slide, please. And the slide after that, that was my next slide, please. So as we have shown earlier, supply chain risks from deforestation can be of different nature and impacts companies differently. So the most important categories to keep in mind are, first of all, the biophysical risks, which are linked to decreased productivity or yield due to ecosystem service degradation stemming from resource scarcity or biodiversity loss or ecosystem degradation. We have the regulatory and legal risk that were just covered in the previous section. We have market risks in situations where information about illegal and sometimes even legal deforestation can dissuade clients to continue working with producers accused of deforestation, leading to potential market share loss. And we have reputational risks that Rodrigo mentioned, basically covered before, in which the company accused of deforestation can become less attractive and hence less likely to find new clients and to retain existing ones. And that's especially true in lucrative markets that attach. Is there any issue with the recording? I can hear someone in the background. No? People can hear me well? So moving on. So these different risks can affect the company's standard financial metrics, such as the net revenue, the gross profits, or the net earnings. And it can have also a material impact on the solvency and the degree to which the companies, the clients, are unable to service their debt obligations in full and on time, possibly leading to loan defaulting. So it's also important to remember that it can change the value of their assets, and also change the asset and liability ratio on the balance sheet, which has in turn the potential to trigger more severe cases of default. For the banks, these changes have direct influence on credit risk metrics, such as the probability of default of the client, the value of the exposure at default, or the loss given default, which together enter into the calculation of the expected loss. Next slide, please. As I mentioned in the first slide, it is not enough to understand the various supply chain risks and their potential financial consequences when people try to characterize the financial aspects of deforestation risk. And this is because the fact of whether or not deforestation has the potential to constitute a material financial risk is influenced by many variables and transfer mechanisms that are both common within sectors, but also unique to each company. It is therefore critical to understand the transmission mechanisms that will turn the environmental peril, the event of deforestation, into an economic risk and subsequently into a financial risk. Transmission channels are the causal chains that explain how the risk impact banks directly and indirectly through their counterparts, assets, and the economy in which they operate. So each step or element in that transmission mechanism is important and should be carefully mapped out, since it has the potential to influence positively or negatively the propagation and magnitude of the risk and its transfer to the bank. In this context, we're going to use a very useful classification system that has been put together by the Task Force on Climate-Related Financial Disclosure, TCFD, which basically divides the different risks into two groups: physical risk and transition risks. In the context of deforestation risk, physical risk covers all the biophysical risks, while transition risk include legal, compliance, regulatory, as well as reputation and market. The flow chart shown on the slide highlights how the negative feedback in environmental and physical cycles can affect the financial performance. In this example, forest conversion to pasture and cropland has the potential to affect moisture cycling and energy balance, and in turn, required to apply additional fertilizer to compensate for the decrease in certain organic components in the soil that previously were enabling high crop yield. This can create a perverse feedback loop that substitute the soil organic elements for mineral compounds, increasing in turn the soil pH and resulting in decreased crop growth in the long run on a soil that is largely depleted. It can also have effects on local weather and rainfall patterns, like in the Amazon, where a correlation between deforestation, reduced rainfall, and agricultural revenues have been demonstrated. Next slide, please. Similar transmission channels are found in the mechanisms propagating deforestation risk through transition risk. So transition risk drivers arise as a result of transitioning economic conditions, realizing a new context that recognizing the importance of preserving forests and is increasingly keen to punish acts of deforestation, either through new policies, as we've seen during the section that Lara presented, or through voluntary signals and actions directly taken by market actors as a result of their increased public commitments, such as the no deforestation, no peat, and no exploitation commitments. So again, in the flow chart presented on the slide, the possibility of a new carbon policy that could affect the agricultural sector might result in a higher probability of pricing the CO2 coming out of each farm. That would mean that each farm individually would have to pay for the amount of CO2 they produce, which will have potentially a material negative impact on their bottom line. That impact will decrease potentially their ability to repay their loans to the bank, and will change and affect their solvency and all of the metrics linked to credit risk for the bank. So the likelihood and size of the impact of deforestation risk can be, as we see in this example, affected by a number of complementary and additional variables. So in addition to a policy or a regulation taking place in a country, there is also considerations around the geographical location of the bank, the asset location of the clients, the interactions and interdependencies between the different transmission channels, as well as other climate risks that can amplify impacts, or on the other hand, mitigate impacts, and to the extent that it could eventually reduce or offset the negative aspects of the causal chain. Next slide, please. So as we alluded to at the beginning of that section, attempting to assess the actual financial exposure stemming from deforestation risk requires to rely on methods and models that are still very much in development, combined with a very clear appetite for technical solutions. So this training program does not have the ambition to provide a comprehensive nor thorough deep dive into the various models that have been tested to date, but rather to give you some ideas of the range of solutions that could be at your disposal should you be willing to investigate further. So one way, perhaps overly simplistic, to classify the current state of financial risk, deforestation risk models, is to distinguish between models that rely on scores and ratings, and models that require to construct simulations and scenarios. So on the one hand, scores and ratings provide a synthetic assessment of the risk that is meant to encapsulate in one single metric the different dimensions of the risk, but also its transmission mechanisms and channels. It's a convenient way to measure and compare companies and to compute their respective probabilities of default without having to disentangle all the interconnected relationship linking the environmental world to the economic world, and then the economic world to the finance world. However, its strength is also its weakness, in that it's largely a black box. Reducing the complexity of the risk transfer to its single measure, or at best a scoring system, prevents risk managers from fully understanding how the risk evolves through the transmission mechanism and where direct actions could be taken to mitigate its impact. It's an incomplete and limited method to properly assess the risk. On the other hand, simulation-based models intend to describe and simulate the causal pathway linking deforestation to economic impact and financial impact. Those models enable a nuanced approach that can look at the different risk drivers, such as reputational, regulatory, or market-based, to determine their respective contribution to the risk profile. That in turn enables a prioritization between different risk management solutions based on which risk type is more likely or more severe. On the flip side, the downside of the simulation and scenario-based models is that it requires a level of investment and capacity that is far superior to the scoring and rating approach. And it's also important here to note that from a pure credit standpoint, both will provide an estimate of the probability of default, the PD. The difference being that the scenario approach should be sufficiently comprehensive to also support calculation or basically inputs into the calculation of the exposure at default, so the EAD, and the loss given default, the LGD. Furthermore, the scenario approach is also very useful when you want to compute the unexpected loss profile, also called the economic capital. So for banks and risk management teams who are interested in not just looking at their average exposure, but also the magnitude of their unexpected loss profile, scenario and simulation-based models would have to be prioritized. Next slide, please. So looking first as some examples of scoring and rating models. The screenshot on the slide will give examples of different NGOs' deforestation scoring tools that would give companies a rating based on their performance in addressing and managing deforestation. These scoring tools typically aggregate different risk issues using qualitative assessments, interviews, and expert judgment to produce the score. You've seen in the previous sections example of those tools, like Trace, for instance, or Forest 500. Another tool is called ZSL Spot, which is quite useful if you have some exposure in the palm oil, tropical forestry, and natural rubber sectors, because it provides an assessment of the performance of companies in that sectors against over 100 sector-specific ESG indicators, and they benchmark the progress over time. So very similarly to what Forest 500 and Global Forest Watch Pro and Trace are doing, this is another tool that will help you collect information about the deforestation profile of companies in basically in an attempt to rank them, compare them, and prioritize them. There is also, as you can see, a screenshot from Forest 500. You've seen the video explaining what Forest 500 is about, so I'm not going to get into too much detail here. So I would say globally, those scoring schemes have two primary benefits. They make it relatively easy to rank and benchmark companies in the same sector, which allows to quickly identify champions and companies that require more significant engagement. Secondly, they also provide annual updates, which helps track how much and how fast companies progress over time. But on the flip side, these transparency tools are almost always dependent on publicly available information, which might or might not be a good indicator of the actual performance of your clients and ultimately your exposure to their risk. Next slide, please. Another approach is to modify the internal scoring system of the bank to include deforestation-linked considerations to the calculation of the risk profile. One practical solution is to use a scorecard system to assess the importance of deforestation risk for the clients. In the example shown on the slide, the scorecard is comprised of two different scores, one that reflects the quality of the client's internal policies on deforestation, and one that captures external policies, which are then combined to form an overall assessment for the client. The questions can be weighted differently depending on the aspects that are the most important for the bank. It can also combine elements from external scoring tools when the bank does not have the information. What's interesting is that an internal scoring system, such as the one presented in the example, can allow the bank to be in full control of the risk assessment. The bank can include or exclude criteria, change the weighting system, and they can also add qualitative or specific evaluation criteria to obtain a score that accurately reflects both the risk appetite, but also the risk structure of the bank, in addition to the overall risk objectives that the bank is pursuing, as we've seen in the previous module. An internal scoring system is also naturally more closely integrated with the credit risk decision system and the decisions of providing credit to a client. So you can use a scoring system internally at relatively low cost to help price individually interest rates for your different credit products, but also to calculate the amount of economic capital to hold against the position. So it can be a useful tool in some situations. Next slide, please. A third option is to use some ESG adjusted financial ratings. These ratings are provided by rating agencies such as S&P or Moody's, and they are becoming increasingly common. For instance, the example on this slide describes the methodology used by S&P for the inclusion of ESG criteria. So it's not just limited to deforestation, it includes many more environmental and social and governance-based aspects as well. But the methodology is essentially the same if you just look at deforestation. These factors can influence credit ratings when the rating agency deems them sufficiently material to affect their view on the creditworthiness of the issuer, which means that at the end of the day, the rating agency will combine a qualitative and a quantitative assessment to determine if deforestation under current circumstances can be deemed material for the client and worthy of being included in the rating basically system. At the same time, I think it's important to remind people that in the context of basically, I used information from a report that S&P prepared in 2021, and in that publication, they publicly acknowledge that to date, nature-based risks have rarely been a material factor in S&P's assessments of an issuer's creditworthiness due to uncertainty surrounding the likelihood, timing, and magnitude of potential credit materialization drivers. So there is the possibility that those ESG adjusted financial ratings underestimate the real risk simply because either the information is difficult to access or the rating agency looks at the company globally and don't necessarily take into consideration more specific issues that might be more spatially bound and limited to one single country or region. So I think you always need to take into consideration the fact that those ratings are basically aggregators of multiple different information, sometimes that contradict each other. And so you will need to be able sometimes to unpack that information and determine for yourself whether or not you need to readjust the scoring to a level that is more appropriate to your own risk profile and your own risk appetite. Next slide, please. Moving on now to the second family of approaches, those based on simulations and scenarios. As I mentioned earlier, these approaches are significantly more demanding in terms of resources and capabilities of the risk management team that would be in charge of their design and deployment. But in investing into this more complex model, the bank can expect to have a nuanced and comprehensive view of how deforestation affects their clients and how and when these impacts can translate into credit risk. I think it's even more interesting that a probabilistic simulation approach, such as the value at risk approach or the expected shortfall approach, can give information about the variance of the risk, the standard deviation of the risk, which allows the bank to calculate its economic capital and the unexpected loss level, two information that are often critical in the engagement with the central bank or the supervisory body, but also internally for the efficient allocation of capital. So a simulation model is a sequence of different sub-models or sub-components that are linked to each other. It starts with a central piece or a central research element, which is the description of the risk transmission mechanism. At the center of that mechanism lies the vulnerability model for either the sector or the client. It encapsulates the relationship between the primary risk, in this case, deforestation, and the various economic impacts for the client. Because the vulnerability model is comprised of the different underlying factors, the analysis needs to start with the identification and categorization of the various factors. So for instance, is the client susceptible to reputational or market risk? Are the conditions prone to a change in the regulatory environment that would increase the risk of leaving productive areas stranded? Is the client showing evidence of biophysical impacts in its productive outputs? Those are the kind of questions that will have to be sort of answered in developing a vulnerability model. And so each factor is then included or excluded in the formulation of the risk scenario that will be used to define the risk transmission mechanism based on the materiality. This step, the step of determining the materiality, is often informed by inputs from experts within and outside of the bank. And finally, the third step or stage will be the calibration of the various risk factors. The three most important characteristics of the risk factors that will have to be calibrated are the probability distribution for the risk, the magnitude of the impact on the financial metrics of the client, and to the extent possible, the standard deviation or volatility of the risk factor. The calibration can be based on historical data, which is what is typically used in the case of a value at risk approach, or it can be based on forward-looking simulated information at a desired level of confidence, as in the case of stress tests. Again, shown on the slide, which is borrowed from one example assessment that UNEP-FI carried out for the palm oil sector. You can see that, so it's on the right-hand side, bottom part of the slide, that the biophysical factor, risk factor, has been calibrated to represent a peril that has high frequency, meaning a high probability of occurrence, but a small severity. So what it means is that this is a risk that is expected to happen quite often, but with moderate impact on the bottom line of the client. Conversely, legal risk was deemed severe, but quite improbable, resulting in a shock that could disrupt the client, but with a low probability of occurrence. And so each simulation will require its own calibration, and that calibration ideally should be informed or based on actual data that the bank earns. Next slide, please. So this slide will continue on this example for the palm oil sector. It shows how typically essentially translate the vulnerability analysis into the calibration, and from the calibration into the information that will feed into your simulation model. So we can see that in the case of stranded asset risk, which is a form of legal risk, the solution that basically we have used is to come up with different scenarios at different levels of assets being stranded, and then you attach a probability to those scenarios, maintaining the relationship that the more severe the stranded asset policy would be, the lowest the probability of its occurrence would be as well. So you try to ensure that there is consistency and coherence in the calibration process, and that it mimics very closely the actual economic transmission channel that is basically analyzed and identified in relation to how the clients operate. For social risk, it's another approach, which is more based on a causal chain of interlinked relationship or interlinked actions and consequences. And we have, for instance, tried to impact those various steps, connecting the social hazards, which in this case was the application of poor management practices, to direct business losses in the form of spoiled fruit bunches, acidic CPO, and at the very extreme, the possibility of burn down plantations as a result of social disputes and social unrest. Next slide, please. So I would say that the beauty, or what makes those models interesting, is that then it gives you a probabilistic distributional representation of the impact of deforestation on the client financial performance. So it's not just one single data point, but it will give you a sense of what's at stake or what's at risk from the perspective of the clients when you combine all the different risk factors that are linked to deforestation. From there, it's easy to calculate the expected revenue loss, but also the unexpected loss at the desired confidence level. And with that information, you calculate the economic capital, as I mentioned earlier, and you can also calculate the expected shortfall, which can be quite useful. Next slide, please. So another interesting aspect of a scenario-based model is that it enables the breakdown of the overall risk exposure by risk factor. So in case, again, of our study of the deforestation risk linked to the production of palm oil, the method highlights clearly that both the legal factor, which equates to the risk of being fined for illegal deforestation, or the stranded asset factor presented earlier, are the main factors explaining the overall risk exposure in the case of an archetypal palm oil producer. Biophysical risk, on the other hand, because they are less volatile and have more limited impact, don't contribute significantly to the risk profile. Next slide, please. The simulation method gives access to very interesting complementary risk analysis, such as the one shown on the slide. It shows, for instance, that the individual contribution of each risk factor to the total risk profile, not just in terms of the contribution to the expected loss, but also the contribution to the variance of the risk, which again could become very useful when you need to assess the potential capital that is at risk. Next slide, please. In the case of, for example, it's then possible to fit each risk factor on the quadrant representing the different risk profiles. One axis representing the expected loss, and the other axis, the variance. Banks will, in this case, be especially sensitive to risk factors that are deemed high volatility. If the risk is characterized by both high average impact and high volatility, it's a major risk factor that has the potential to significantly affect the client's solvency. Even more worrisome is a factor with high volatility, but low expected impact, as it might indicate the presence of an overlooked black swan, against which the bank is probably inadequately prepared. Next slide, please. So finally, a few words on the application of the simulation model to stress test requirements. A stress test will normally follow a similar method to the one I have just presented, with one major modification. Rather than using historical data, it will rely on forward-looking projections for the calibration of the different risk factors. So normally the forecasts used are based on extreme values to evaluate the ability of the bank to withstand severe adverse economic conditions. And in addition of the calibration of the perils, it is common practice to also update the models used for the transmission channels to better reflect technological and economic changes that are expected to be introduced over the time horizon of the analysis. So it's essentially the same model, but it will look at forward-looking data, stress the data to obtain a projection of the capability of the bank to withstand extreme economic and financial situation. So in this case, if you have a need to apply a stress test, and that stress test includes components linked to deforestation risk, it might be that you will have to develop or use a scenario-based model. Next slide. So to wrap that section up, a few key messages about the financial lens. So as we've seen, the financial risks are comprised of all the legal and reputational risks, as well as the biophysical risks. So it's basically the aggregation of all the risks that we have seen before in the presentation, but with a dollar sign attached to their impact. This is an emerging research field with few definitive answers, and more work has to be done. Two families of approaches are dominating current implementations: model based on scores and ratings, and models based on scenarios and simulations. And they have both advantages and limitations. As we've seen, models based on scores and rating are easier to implement, but they tend to hide information on risk transmission that could sometimes be useful for the bank in its engagement with the client. And simulation approaches, on the other hand, are more advanced, requires more resources and capabilities, but they provide a richer, more nuanced understanding of the various risk factors. And they can also be very useful if there is a need to develop forward-looking stress tests. And this slide is the last slide on financial lens. Back to you, Rodrigo.
So great. So we have now a few minutes for questions. I see one in the chat already, Jonathan, that links to what you just presented. So if I may just hand it back to you. Is there any resource doc with a fuller description for this palm oil example on quantifying the deforestation risk? This is from Yvonne. Jonathan, if you could just, so the question is on the, if the documents on the palm oil case is available.
Yeah, sorry, I was mute. I was on mute, essentially. I was in the process of saying that, yes, we have a presentation that details the methodology, the different steps and the approach that we have undertaken. We are also very pleased and willing to schedule a chat if useful to explain in more detail how we've basically designed and carried out the methodology in the context of this example.
Yeah, probably what we could do is add a copy of the presentation in the training materials as well, if that's okay, John.
Yeah, absolutely.
Any other questions? So we are not that big of a group, so if you can simply unmute yourself and or type the question as well. I can read it if you prefer. Okay. There was a lot of information presented today, so there was a lot of ground to cover. So yeah, we are happy to get questions afterwards as well. So if you if you have any questions that were not answered. Vincent.
Yeah, hi. I was wondering, are there any publications out there in the public domain related to stress testing for deforestation? I mean, specifically for that.
To the best of my knowledge, not specifically on deforestation. You have the European Central Bank and the Dutch Central Bank that have both produced guidance on how to carry out stress testing for climate-based risks, so including both physical risks and transition risks. So I think we'll be able to share the references either in the chat box or in the subsequent email that we'll send to the group. To the best of my knowledge, I'm not aware of a model that looks at it strictly from the vantage points of deforestation.
Okay, thanks.
Yeah, it's broader than deforestation, but the most recent report from the NGFS, or the Network for Greening the Financial System, on biodiversity and financial stability, one of the key recommendations from the report is actually focused on the development of stress testing and scenarios for biodiversity loss, and this would encompass deforestation necessarily, as it's the largest driver or the biggest driver of biodiversity loss. So that's we can also share the report as well if you have not seen it. Any other questions? So as I said, we are happy to get the questions by email as well. So if you have any questions left, please send those through. Next slide, please, Laura. So the next module on managing risk and exploring opportunities will take place next week. So we have a window of a few days between this session and the next session. So it will be module 3 of this training. To introduce mitigation actions that banks can use to reduce deforestation-related risks, and also explore various opportunities for producing innovation to support sustainable commodity production. And yes, this will take place next Tuesday and Thursday, so next week. Next, please. Thank you very much for joining, and here's a reminder on the next date when we will meet. So thank you very much.